you also have this presentation in front of you, how to win with capitalism, or how to win using capital markets. We are going to also clear your plates, so we can do that while we're doing this. This is a short presentation that simply touts the benefits of discipline, and it basically answers the question, but Evan, this hasn't happened before, right? I've gotten this before. You know, we haven't had Ebola, we haven't had terrorism like we have today, but we've had a lot of stuff, and that's what I want to try to remind you. If you look back 2,000 years, look at this little dark blue bar here. 23% of all the goods and services ever made since 1 AD were produced in the 10 years that are 2001 to 2010. We are in an explosion of wealth. Check this out. You may have seen this before. Charlie, does this turn up? Thanks. I won't play the whole thing. It's pretty long, but how many of you have seen this Corning commercial? I'll play a little more of it. It's really cool. Goes on and on. Goes to the car, goes to the bus stop. This glass is everywhere. This is one company's way of saying how we're going to take over the world, right? Dow Corning. If they wanted to get involved with every area of your life, they could. Not sure it all scales quite yet. But I ask the question, where's the optimism? I ask the question about capitalism. I am not the kind of person that thinks the big companies are evil, okay? The research and development that goes in to make your life better and come up with things that create cool stuff and necessary stuff comes from profits, okay? And a company that doesn't make profits doesn't exist tomorrow. It doesn't exist tomorrow to give you a job. It doesn't exist tomorrow to come up with a new product, to come up with a solution. And profits are being denigrated in this country right now, and it is not right. And so we're looking at the profits coming from the companies of 13,000 organizations worldwide, and we're wanting to invest in those companies and bring you the return that comes from that, okay? So I am not going to be at all ashamed to talk about the fact that, in that sense, I'm a capitalist. I don't think capitalism is bad. Capitalism should be better defined by those who believe in it. That's part of what I'm going to do. So I say, where's the optimism? Now, what I did for this presentation is I went back almost 100 years, 90 years, and we built a portfolio of just U.S. sectors. So we've got large, we've got small, micro, large value, small value, T-bills, 5-year government bonds. So we have a 60-40 fund here, no, a 70-30 fund here. 70-30 happens to be the average of all of my clients, essentially. We've got some real aggressive, we've got some more conservative, but the average of you, if you were to put it all together, is about 70% stocks, 30% bonds. No one of you might be right here, but this is a good average. I don't have international here. I wanted to go back to the 20s. I wanted this to be meaningful, and we don't have good data internationally past the mid-60s. So we're going to be looking at just the U.S., and if Mark Mattson and Eugene Fama and Harry Markowitz were around in 1926, this is the portfolio they would have built for you, okay? Now, we look at what happened in the 1920s. None of this happened before. Russian Civil War, Benito Mussolini, hyperinflation in Germany, this was the Weimar Republic. Chinese Civil War, the Wall Street crash began 1929, the Great Depression ensued at that time. These were all brand new events, right? None of that happened. It's all always new. And in the 20s, we have data from 1926, thanks to one of those guys I showed you earlier, Rex Sinquefield. And had you put $1 into a fund in 1926, in June, your dollar would have grown to $1.35. You can write that in if you want to on your book. Your dollar, or that 5-year period, 4-year period, would have grown to $1.35. What is that, 3.5 years? Now, compare that to inflation, as measured by the CPI, the Consumer Price Index. Inflation actually caused your dollar to be worth more from a cost of goods standpoint. You could buy more goods for $1 than you were able to prior to that 4 or 3-year period. And your dollar was worth more. So this decade, although troublesome, stock market still left you with more money at the end of that decade. 1930s, Holodomor starvation. That is in the Ukraine, Russia. Holodomor starvation is an exercise in centralized government's worst. There were fields full of food that could be harvested, and because of the law at the time that said the food had to be distributed equally, the people right next to the food weren't allowed to eat it, and it rotted in their own barns because of the law of the time. That's a centralized government's decision at its worst. We all know we need governments and to help us, and I'm not against government, but some of what was happening was definitely wrong. The Holocaust, 1933, U.S. presidential candidate Huey Long assassinated. The Gulag death camps during that period of time. Other wars, Hindenburg airship explodes, World War II. There's the Hindenburg. An amazing event. An amazing event. Put $1 in the stock market, January 1, 1930. And at the end of that period, you had $1.52. Nobody believes this. I didn't believe it. Now, we talked earlier about things you must endure. Right? How much was that dollar worth? About 35 cents for a little while, right? And that's not easy. And this is a 70-30 fund, so most of you aren't turning 65 here, right? This could happen again. Most of you aren't turning 65 here. If it happened and you were in a 30-70 fund, 30% stocks, 70% fixed income, you might lose 10% of your money on the worst thing that could potentially happen. So you, again, remember, this is a more aggressive fund, but still turned into $1.52. And further deflation. So the dollar bought more goods. The price of goods went down. So the spread, which is what I'm constantly talking about with you, is that if you take any long period of time, you have a spread between the value of the dollar, or the growth of your assets, of about 6% on average over any 15 to 20 year period of time, where your invested assets do about 6% higher than inflation as measured by the CPI, and in some cases much more than that. The 1940s, the Holocaust, World War II, Japan's bombs, Eastern Europe handed over to Communist Russia, the Berlin blockade, the Cold War began 1949 and went on for almost ever. And you put $1 in the stock market in 1940, and over the end of that period of time, $3.36. And this is accurate data. We have the data. Almost nobody did this. The stock market was where you lost money, right? So almost nobody got these returns because almost nobody felt like they could be there. And yet, guess what? Companies found a way to make profit. Some companies went out of business. We would never try to build a portfolio with 17 companies in it. We're going to own all the available companies. We can never determine which ones are going to go out. We constantly see portfolios coming across our desk with 3-4 companies in it total, and they're looking at it and saying, hey, these are good companies. You know, good companies can go out of business, and we cannot give ourselves to that kind of exposure. We never know which ones are going to be there, and if we own them all and we diversify well, we can enjoy that rate of return. Anybody have an idea which city or two cities this is? It's Nagasaki and Hiroshima today. I love that picture. Looked a little bit different in the 1940s. 1950s, the Cold War. Mao Zedong takes power, Suez Crisis, Cuban Revolution, the Vietnam War begins in the late 1950s. And that seemed to go on forever. And $1 grew to $3.93 during that 10-year period of time. Inflation brought the value of $1, or what you could buy for $1, you had to pay $1.22, $1.23 for at the end of that. But again, your buying power increased for your invested assets. Inflation was taken care of. 1960s, the Cold War, Vietnam War, Berlin Wall was built. Cuban Missile Crisis happened. JFK was assassinated in 1963. Coup d'etat, Brazil, Six-Day War, Martin Luther King assassinated. Late 60s, Libyan Revolution. A lot's happening here. And $1 grows to $2.59 during that 10-year period in a diversified U.S.-only fund. These start to get better on average by a percentage point by bringing in the international and emerging markets. 1970s, Cold War, Vietnam War, beginning of terrorism, the 1970s. I didn't come up with that one. Someone asked me at the last one, what was the beginning of terrorism in the 1970s? I didn't have an answer. Who's the historian that's talking? Person?
I know, obviously, I know on math, but I was saying, was Patty Hearst, was that case going on in the 70s?
Patty Hearst?
Yeah.
I thought that was the 80s.
I'm going to look this one up and write a blog post about it because I should have known.
Domestic terrorism,
They took over
the friend of the president, he was blowing up places. There were some other radicals in the country, but you also had 1979 was the fall of Iran, and then the hostage taking that took place in April 1979.
Yeah. In the late 70s, Saddam comes to power. 1972, kidnap of murder of Israeli athletes at Olympic Games, and the birth of yours truly, 1972, Evan van der Weyck. Wasn't ready for that.
It didn't go down?
No, everything seemed to be okay. Actually, 73, 74 were pretty bad, as you can see. We saw some decline right after that. Looks like markets did revolt a little bit, but $1 still grew to $2.71 during that decade. And you know, if money doubles in a 10-year period, by the rule of 72, the rate of return would be 7.2%, right? If the money doubles in a 10-year period. Most of these decades, money is more than doubling during that period of time. The S&P 500 wouldn't do that all by itself, but because you have small companies, micro-cap companies, value companies all in this mix, you're doing a little better. So diversification has worked for a very long time. 1980s, the Cold War, Mount St. Helena erupts. Iran, Iraq, revolutions in Nigeria, Bhopal disaster, on down. The space shuttle crashes, first intifada, Tiananmen Square protests, 1989, and $1 grows to 4.53. But you have to look at inflation because inflation was really quite big in the late 70s and the early 80s. What you could buy for $1 in 1980, you had to spend $1.74 nearly in 1990. So we lost a lot of buying power, but again, what's the claim? If you're losing buying power on the dollar, where's the hedge? It's certainly not in gold consistently. There are periods of time where gold goes up and down, but gold's a commodity and it gets 3 or 4% in the long term. Stocks have a cost of capital story that is much better and provides that hedge against the inflationary loss of value of your money. 1990s, this is now triggering our more recent memory. Cold War comes to an end essentially during this period. Maybe starts up again now. I don't know. Is Russia behaving themselves? Soviet Union collapse, Waco tragedy, Rwandan civil war and genocide, Oklahoma City bombing, Olympic Park bombing, Columbine shooting. Columbine shooting 15 years ago. I don't make light of these things to then say, hey, look at the money we made. That's not what I'm doing here. Honestly, I'm not doing that here. But neither am I going to let you come in to my office and say, this has never happened. You know, everything's going to come apart now. Well, none of it ever happened. That's why they call it the future. And we don't know what it's going to be, but I know it's going to be different than we've experienced, or it's not going to make the headlines. They don't tend to want to rehash 2011 for you, and I hope you still are watching. But in the 1990s, a buck grew to 338, a little less inflation during the time, but still some. Or 338, I'm sorry. In our diversified fund. And then in the 2000s, we had some pretty rough times. So they call this the lost decade. Had you owned just the S&P 500, just the 500 largest companies in the United States, you would have made no money, essentially, during the entire decade. It might have been about 1% total. But a diversified fund did pretty well. And the reasons, almost all the biggest events in 2000s were actually related to my field, right? The tech bubble bursting, 9/11, obviously targeting the financial markets and the financial strength of the United States, Enron collapse, current war on terror, brought to the new level. Indian Ocean tsunami happened in 2004. I couldn't believe that was 10 years ago already. Lebanon war, housing crisis and market meltdown, all related to our finances, all related to our wealth. And a pretty rough period by the end of 2010. But a dollar still grew to $1.84 if you were diversified. So that's about a 6% return during that period of time in a U.S. only fund. During this decade, a fully diversified fund was nearly 7% net rate of return to you after costs. That's the dead decade. That's the decade where you weren't supposed to have made money. And almost nobody did because they were jumping on bandwagons over and over again, and they were looking at wealth in commodities, looking at wealth in techs, and this is what got me into this business. The tech bubble bursting is what really finally ticked me off to the point. I had loaded up on all those big U.S. tech companies as my advisor was expecting me to do, and I was buying the mutual funds that were loading up on these, and I had 3 or 4 mutual funds with very similar companies inside, and I went down 60-70% in 2 years. No, it's not. I was 30 something. It wasn't going to kill me, but it was pretty frustrating. Where's that market return that's coming? And then when I heard, hey, you're buying previously positive mutual funds, and that doesn't fare real well in the long term, I woke up. So through wars, depressions, natural disasters, catastrophic historical events, we find a way. Capital markets bring a return. And we need to remove that twinge of greed, for lack of a better word, when we see someone or hear someone getting that extra percentage point because they happen to be in small, and they happen to be in a mutual fund that owned more of what went up, asset A, right? Well, we own asset A and asset B, so there are many years where we won't be as good as the S&P 500. 4 or 5 or 6 of them out of 40. We're not going to do as well. This year's one of them. But over the long term, you're going to own all the right ones. You're never going to have had to guess right. You're always going to rebalance back into the ones you should own. And you'll do very well when you own them all over the long term, even net of all fees.